Every trader repeats the same advice. Always take trades with at least a 1 to 3 risk-reward ratio. It's printed in every trading book, taught in every course. It's also incomplete advice. Incomplete enough that most of the traders following it lose money. Risk-reward by itself doesn't determine whether your strategy is profitable. The variable that determines profitability is expectancy, which combines our R with win rate. Today, why R alone is a lie. The expectancy formula that actually decides whether your strategy works and how Confluence affects both sides of the equation. Here's the formula nobody shows you. Expectancy equals the win rate times the average winner minus the loss rate times the average loser. With a 1 to 3 RR and a 30% win rate, you're roughly break even after costs. With 1 to 3 and 40%, you have a clear edge. With 1 to 3 and 20%, you lose money slowly. RR is one input to expectancy, win rate is the other. Most traders obsess over RR and ignore win rate. The math doesn't care which one you focus on, it cares about the product. Watch this on synthetic results. A strategy with a beautiful 1 to 3 RR but only a 30% win rate. 10 trades, 3 winners at 3 are each equals 9 R, 7 losers at 1 are each equals 7 R net, 2 are over 10 trades before costs. After commissions and slippage, basically zero. The RR looks great in isolation, the actual P&L is flat. That's the math the books don't show you. Beautiful RR without sufficient win rate is a treadmill. Here's why Confluence matters for expectancy. A multi-factor Confluence setup raises both inputs at the same time. The structural target is usually farther than a single indicator target, improving RR. The multi-confirmation entry produces fewer false signals, improving win rate. Both numbers in the expectancy formula go up. That's why Confluence-based methodologies outperform single indicator strategies, not because RR is better in isolation, but because the entire equation shifts in your favor. Now with Confluence, a multi-confirmation setup with 1 to 3 RR and a 50% win rate. 10 trades, 5 winners at 3 are each equals 15 R, 5 losers at 1 are each equals 5 R net, 10 R of profit over 10 trades. That's not a treadmill, that's a real edge. The RR looks the same on paper as the previous example, but the win rate is 20 percentage points higher because the entry filter eliminated the bad setups. Same RR, completely different P&L. On your own trades, the practice is simple. Track win rate and average are per trade. Plug them into the expectancy formula. Anything above 1 R of expectancy per trade is a strong edge. Multiply by trades per year for annualized return. If your expectancy is below 0.5 R, you don't have a robust edge yet, regardless of how good your RR looks on screenshots. The number that determines wealth is expectancy. RR is just one ingredient. So, 1 to 3 risk-reward is good advice only at a sufficient win rate. Below 30% win rate, even 1 to 3 is a treadmill. Calculate expectancy, win rate times winner divided by loss rate times loser, and that's the number that determines whether your strategy actually works. Confluence improves both inputs simultaneously, which is why multi-factor methods outperform. Subscribe for the full method and trade your own plan. Education, not financial advice.